I'm going to call this the Talking Crypto Markets post Fed Talking Heads.
Let's do it.
Now I need to look at some tags. I can't, there is none. I got to get smarter on the tags. And, oh, okay, I'm going to do chatty. Yeah, because we're chatty, right? Yeah.
Chad.
Where to do finance for streams? Okay, finance, chatty finance. Let's go for it. Here we go. And I will edit this up for audio podcast and whatnot. But here we go. 3, 2, 1. All right. Looks like we're good to go. All right. This is the third edition. It's Wednesday, February 8th. I'm Ted, and this is Josh. Welcome, Josh. It's our third live stream. Mark the calendar.
Knocking them off, man.
That's right. Hang on just a second. I'm trying to mute this thing on this side. Good gravy. Technical difficulties abound. But to kick us off, today we're going to talk a little bit about the crypto markets and what the Fed talking heads have been able to achieve. We'll look at some charts, and then we'll make a good hour of it. But before we begin, just want to remind everybody that we are here to educate, we're here to inform, and nothing that we say should really be construed in any way, shape, or form as financial advice or trading advice. Please, 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 please do your own research. You can do it. You have the power and the tools and the technology at your fingertips. And please be aware of counterparty risk at all times. And enough said there. I'll get us over here. And all right, Josh. So let's tee it up for everyone today. What we're going to talk about. I'll let you talk about what you see and what you want to talk about, and then I will kick us off with a chart review after that.
Yeah, I think today, I think we can get into how the market's reacted. I have been busy all morning, so I haven't really had a chance to look at how the market's reacted to the talking heads. First glance, I saw there was some negative reaction. It looks like things have somewhat rebounded a little bit, but I think it's important to go back to what we talked about on Monday, that, this is why we pay attention to some of the things that are going on outside of crypto. We had the State of the Union last night, which, opinions aside, don't think moved the market in any sort of way. Don't know that the market cares anymore what the president says or doesn't say, but what the Fed says does. So I think that is a good tee up to kind of get into some of the charts and go from there.
All right, I think thank you for setting that up. So I'll talk a little bit about what we're looking at here. Oops, I put it on the wrong thing. Here we go. I'll just want to reiterate, if you don't do macro will probably do you from a trading standpoint. What I'm getting at here is to share that on the Trading Economics calendar, which is a great resource, by the way, that's free to use, we had today at 9:15 a.m. Eastern, and then respectively at 10 a.m. Eastern, Fed Williams and Fed Barr both gave speeches that were, if you look at the financial media, they were really perceived as hawkish, which markets have not really tended to like. So over here on FinViz, another great resource, by the way. I've been using this since 2014. I love it, and I kind of got addicted to it because the layout is pretty good, but trying to take the headlines with a grain of salt here. What we don't see right now is there was a headline, I think it was from Bloomberg, that talked about like a 5 to 5.25% interest rate would be quite reasonable given the conditions. So take that with a grain of salt. We saw yesterday's price action with the speech. It basically markets rolled, what they gave the impression, now this is all relative, they rolled over a bit and then retraced, and take any number of approaches around how to try and make sense of what it means or what's happening in the markets. There's a lot of algorithmic trading that has come on the scene the last few years, and I've heard a lot of really smart people talk about, people a lot smarter than I am, a lot richer than I am, that talk about how as retail traders, you're largely trading against robots. And I would argue that the quants is another way to label them. Quants have had some success. They've also gotten wiped out in different periods, like the algorithmic traders, the trading systems that were programmed by humans, but then when they were let loose with lots of cash, may have gotten themselves unknowingly into trouble because they are yet to be programmed to be sentient beings that understand why they're doing what they're being programmed to do. So keep that in mind. A lot of sentiment traders that anytime bad news hits the wire, they just, whatever market they're trading, they just sell everything they can get their hands on, set their risk, and then let it play out, which
So
is
so
largely,
basically what you're describing there is essentially these algos are set to pick up certain words that come across a news wire. And anytime they hit those words, they automatically sell. They're not thinking about it, they're not making decisions. They're seeing something and triggering a sell, right? And so
yes.
there was comments today that hit the wire that the algos picked up, and that's why things sold off. It's not
I would argue,
necessarily human beings sitting at a computer going, "Oh my God, they're raising rates another 1/4%. Like the world's ending. Like we're going to sell everything, right?" It's machines for the most part.
a statistically significant number of participants in the market are machines that are leveraging trading platforms via API, meaning they develop software that listens to data coming from other sources and then will initiate positions over the internet to some trading platform like a KuCoin or a Binance. You can enable API access, and then based on whatever application that you're using, and if you have the skill and the wherewithal to develop and write code and then test and paper trade at first and then go live in a manner of speaking, it's yeah, you can do really well. You can get wiped out, but on the Finviz chart here, or with the Dow, the Nasdaq, and the S&P, just this is a way to just glance at what's going on. I think that it's not an accident that this hawkishness that's being broadcast is being perceived by programmatic traders, or the sentiment, the labels that get put on sentiment, whether it's good sentiment or negative sentiment, or like positive or negative sentiment, the labels that end up getting placed, forget about who's placing the labels right now. What I mean is, like, if the news is being perceived as negative, the sentiment, it tells the machine, if the sentiment is negative, open a short position. This is the amount of risk we'll take, and then here's where our take profit, move this many pips, take profit, or this many percentage points. And at the end of the day, if the trade's still open, close it out. There's a lot of hands off, is what I'm trying to get to. But circling back around, when the talking heads are in the media at any scale, it tends to cause prices to come off, especially if they've been up at all. It
And
sometimes
by talking
initiates profit.
heads, talking heads, you mean Fed when the Fed
Yeah,
speaks,
I
any of
mean,
these
Fed
Feds.
governors getting on TV like Barr or Williams, and gosh, the other guy, the former Dallas Fed chair guy, and I can't, Rich, is it?
Kashkari.
No, he's the bald one that looks kind of crazy in those interviews with that guy where he talks about how he like leans his head back and he's like, "We can print an unlimited amount of money," which is somewhat terrifying depending on what mood you're in if you watch that. The same guy interviewed Powell, and they're trying to explain to the every person in that interview that the Fed has the power to create an unlimited supply of US dollars. And it such a hard thing to like get your mind around, and for a whole nother topic of discussion. But the he has glasses. I promise you that I will look this guy up and talk about him properly. But when someone like him got on CNBC, or someone like Kashkari or Fed or Barr or Williams, or I mean any of the other folks that are not Powell, it doesn't matter. They're the regional Fed governor, Fed president, governor type things. The entities that are regional, they still have the ability to move the market, and it really boils down to, are they talking? Is the tone hawkish? Meaning we got our eyes on interest rates and inflation, and if we need to, we will flex our monetary muscle and we will raise interest rates and we will attack this from a monetary policy standpoint. Or the other side of that is, well, we think that we need to be more accommodating, meaning more dovish, and we need to accommodate. We think that lowering interest rates is going to make credit more accessible to business. Business can increase their capital expenditures because they can leverage credit, not just cheaper, but the requirements to leverage credit change depending on economic conditions and the different issuing banks. All the banks get the money from the Fed, so when the Fed starts to loosen and become more dovish or be more accommodating, that money makes it into the system, and then the lending requirements loosen a little bit. So if I'm a small business owner, I can go to the SBA and I don't have to bring as many documents, for example. I can just get my line of credit, keep my 10 employees paid for the next 60 days or whatever, and then figure out how to pay it back later on. Or if there's some sort of like amnesty program, or like with what was it, the paycheck protection, the PPP, the Paycheck Protection Program. A lot of those loans got forgiven, quote unquote. So they applied for a loan, they got the loan. Where did the money come from is really the question that you should be asking here. And the answer is that the Federal Reserve marked up the balance sheets on the accounts that all of the big banks have at the Fed. And then the Fed took money from their accounts at the Fed and moved them to small business accounts, which all of our bank accounts in the US financial system all make their way back to the Federal Reserve. It was just an exercise of marking up the balance sheets, marking up the accounts with more dollars than they were before, and then letting those dollars make it into the system by way of moving it from one account to another, and then making payroll, which distributed to a larger number of accounts at much smaller pieces. And that's how the money flowed into the system during the PPP, for example. But the point is, circling back around, because I could go on 15 tangents, is that when the Fed governors speak, markets listen, and it has to do whether or not they're talking hawkish or they're talking dovish, or the tone, I should say, because it greatly impacts the Wall Street's ability to make money based on how much money or credit costs in a trading context.
Yeah, no, it's interesting because you know it seems to me as a retail donkey, right? Like this stuff. So the whole market isn't. It doesn't matter that Facebook made $50 billion last quarter. The market goes down because the Fed decides they want to raise interest rates, right? Like that
Mm-hmm.
seems to be essentially what happens. And part of the reason I got into crypto is because, like, okay, like I don't want to play that game. I want to be outside of that system. I want to invest in stuff that isn't dependent on politics and whatever some guy that's the head of a private bank decides he wants to do with interest rates, right? But unfortunately, we have to talk about this stuff because the crypto markets aren't there yet to where they can operate outside of, whatever these Fed decisions are. I'm optimistic that that happens, at some point, maybe not this year, next year, the year after that. But as they grow in size, they'll trade independent of whatever these people are doing at the Fed. And I don't know if that's realistic or not, but that was the idea when trying to get into crypto. Now, subsequently, learned you can't get away from these people.
As long as the U.S., as long as the largest participants that make up the financial system, meaning the banking system, where individual citizens have access to U.S. dollars and then are able to transact, meaning conduct business, buy goods and services, as it exists today. We use debit and credit cards for this. It's they're through issuing the debit card or the credit card is issued through a bank. The bank is a federally regulated entity, and in order to be able to operate in a fractional reserve capacity, they have to follow all these rules. Uh, yeah, so as long as as long as the banking system is closely tied to government and regulation, I think the way that meaning when the Fed does things, it's a monetary policy move. When Congress does things around like dictating what things are going to cost, or tax, like basically fiscal policy would be like a tax cut would be like if so when tax cuts get legislated, that's called fiscal for short. And when the Fed does things to influence the cost of capital, that's monetary policy versus fiscal policy. Just so when you
Got
hear
it.
me say oh, we got a bunch of fiscal, we have a fiscal tailwind. That would be Congress cutting taxes and going on a PR campaign about whoever the president is saving us from ultimate impending doom. Yay, we got that would be a fiscal tailwind, and you might see more risk capital enter the markets and take speculative bets. Anyway, I don't want to get too far down that rabbit
No,
hole.
no, no. It's good. It's a good clarification of fiscal and monetary policy. The long and short of it, though, is we got to pay attention to it, even if we don't like it, even if we don't,
We
agree
do.
with it, even if we think it's insane, if even all that aside, is crypto traders and investors, you have to pay attention to what's happening with these guys and on a day-to-day basis, week to week, month to month, year to year. It still matters and probably will. What you're saying is for the foreseeable future. So it's not something we can ignore. And you don't have to put it front of mind, but it's got to be, at least on your radar.
Yeah, I think a good way to summarize like the way that from a macro, like in order to keep the macro from doing you entirely or having a negative effect on you, but you not really understand what's going on, is that if you in like really simple terms, I think for the retail mind, it's probably a good idea just to understand like where do we stand and like what's the current interest rate, and is the Fed, are they talking the hawkish, is the tone hawkish or is the tone dovish? That's really like, anything else to me, like in the way that I trade, because I don't, I'm not running a hedge fund. I don't have a billion AUM, assets under management. I'm not trading other people's money. I mean, I'm not taking positions in highly illiquid derivatives products that, can wipe out, the GDP of a small country if it goes the wrong way, things like that. What I'm trying to communicate is that if policy is dovish, you should see risk asset prices go up because, quite frankly, it's less expensive to borrow money to then play the arbitrage where you borrow at 2% or 1%, put on these trades that run 10, 15%, and then you pay back the loan, and you used money that wasn't yours to make money, and then you pay back. Like a great example of this, a guy named Warren Mosler, uh, he was a hedge fund guy for a long time, still is, but he's a politician in the Northeast, I think Massachusetts or somewhere in Boston area. Met him through the former Big Boss on St. Croix, and Warren Mosler's big claim to fame was an arbitrage play where they would borrow the in Italy. They borrowed money from the bank in Italy at 12% interest. 12, okay. Doesn't really matter what the interest rate is as long as you're making more. And they then bought the Italian government debt, which paid a coupon of 14%. And they, for 12 or 13 years, they scraped 2%. It's called arbitrage. Or when you hear
Hmm.
them talk, they're like, yeah, we scraped arbitrage at 2% for 14 years and made $100 million doing it. And like,
But
wow.
they're
And they didn't
trading.
have,
They're trading billions of dollars on that. That's how they
that's
do
right.
that.
But
Yeah.
scrape all the zeros off the end. If you borrow $1,000 and you're able to then make, let's say it's 10 months because the math will be super easy for me. You borrow $1,000, you owe $100 a month. You buy a yielding asset like a bond that pays 3% or 30. Let's make it 10% to make it easy. So every month you get paid $110. You take your $100, you make your principal payment, and you keep the extra that you made. You put that in your pocket, and then you go about your life. And you come back at the end of the next month, you get another payment, you make your loan payment, and you keep the difference. So the difference in what it costs you to service your loan and then the dollar amount that you're getting paid for holding this yielding asset is where you scrape off the top, and the difference is the arbitrage opportunity. That's uh, another time. Carl Icahn. If you don't know who Carl Icahn is, get on Google, and the dude's worth like $60 billion or something like that. Is really really famous for finding these types of trades where he's able to borrow money at a ridiculously low rate, buy some yielding asset, and then use the income to make the loan payment and keep the difference. And you scale that across hundreds of yielding assets and hundreds of loans. And if you go out and raise money to do that, you've got that's easy money. kind of like, and I think you could probably make a good example with your commercial real estate experience. You buy a yielding asset that makes your mortgage payment for you, and you keep the difference.
Yep, and so this is where the Three Arrows Capital guys got in trouble with Luna, right? Because they were trying to do an arbitrage plays. They were borrowing money from all these other creditors at 3, 4, 5% and getting this imaginary 20% yield from Luna, which was unsustainable, right? Like it was
Hmm.
just looking back on it now, it was like, how did they even think that this was going to work, right? Or maybe they didn't, right? Maybe they knew it wouldn't work forever. But when you're doing those kind of strategies, stuff goes wrong too. And in real estate too, I mean, you could have the best play in your mind set up. You have a lease signed with somebody, you got everything, you got your bank loan at 3%, tenant's giving you 10%, tenant goes bankrupt. All right, sweet. Now I got to make another plan, right? Like, so
Yep.
even in those kinds of trades, things can go wrong. But let's circle back to the why we care, right? Because when you mention sorry, I can't talk risk assets. What you mean is crypto, tech stocks, anything that's growth, right? And so we've
Yeah.
talked about this in the port. When they say dovish, that means they're potentially stopping rate increases or potentially cutting rates. Hawkish means they want to increase rates, right?
Yes. That's
Okay, and
exactly
so
right.
so that's what we kind of need to pay attention to, and we've talked about this too outside of live streaming. Is my personal view is that the markets at some point, when they stop raising rates so fast, right, and they normalize at 5.5, 6, whatever it is, the markets aren't going to stop investing in growth, right? Like if the interest rate is 6% and Bitcoin grows at 150% compounded over every 5 years, I'm still going to want to buy Bitcoin. I don't give a shit that it's 6%, right? And that's my personal investing strategy. If you have $100 million, maybe you're fine earning 6% in the treasury bonds, whatever. But
Hmm.
in a growth stage, and I still think there's investors, and that includes tech too. I don't think tech goes away because you've got these AI companies going on. Tech is just going to keep getting exponentially better and faster. And I don't think because interest rates are a little bit higher, people are going to stop investing. Now, people that are in the markets and everything you see on TV tells you that that's the wrong way to look at it. Don't really care from my perspective. Like, I'm still going to be investing in tech for the next 10, 20, 30 years if I can, because I enjoy it. I think it's fun. I think that's where the opportunity is. What are your thoughts on that?
I very much agree with what you just said about like the technology is the thing. Uh, it's interesting to like one thing trying to like concisely recap something you said around like if you have $100 million and you're okay with 6%. I mean, depending on how much capital you have to put to work, you may reach a point where you're comfortable with the income that it creates. If it's like being in the game to put on trades is not of interest to you, but you're just more interested in having a nest egg, preserving it, you may hire a fund manager. You may go to like a Morgan Stanley or uh, Schwab, whoever, Fidelity. You may have your nest egg with them, pay the management fee, and let them sort out the details. But in aggregate, your wealth is preserved at a minimum, and it's generating income or yield of some kind. Then you're probably in a good position. But for our purposes, thinking about and the example that you made with Bitcoin's compound annual growth rate, you literally don't care what the interest rate on the U.S. dollar or in the what the Fed's decision around monetary policy is. It could be, it was great being at zero for a long time, and that made it really easy to borrow money for nothing and take these huge bets. And depending on who you are and where you are on the spectrum, like from a wealth standpoint, like how much capital firepower you have, and it made it really easy for the people on Wall Street who were in the banking system to begin with. They are the banks most of the time. They can take money from the Fed that they didn't have to pay for, that they were going to get anyway. The Fed literally supplies the banking system with the money to distribute. Uh, so they were able to take money at 0%, put it to work, and make 18 to 30% in the S&P 500, and that was the trade for years.
It's kind of
Um,
kind of funny how that money that got, you know, extended to your close personal friends didn't really make it very far. Uh,
yeah,
outside of to the no, I think that's where people get upset. I think that's where, once you start to understand that, like, look, they created money for nothing, gave it to their buddies, and their buddies went out and bought hard assets. And it's like, okay, like, that's a fine game to play, but not everybody got to play it, right? And what we're talking about here is the Cantillon effect, right?
yeah. I
Are
don't
you,
know, like Cantillon or Cantillon. I don't know if I'm pronouncing it
yeah,
right, but yes, I know what you're talking
basically,
about.
basically those that are closest to the money printer reap the rewards, right? Because we're in this game because the value of the dollar is decreasing every single day. So those dollars get created, they're worth more the day they're created than 10 years down the line. But by the time the average person sees those dollars that were created during, let's just say, the crisis that happened over the past couple of years, by the time they reach you and I, they're worth what? What's inflation right now? Let's just say real inflation is 20%. So over 5 years, how much are they worth by the time you and I get them? Right? You can't buy the same amount of stuff that you could 5 years ago. So that's where you and I would say, okay, well, I'm better off today taking my dollars as they exist today and buying something like Bitcoin, which isn't going to inflate away and is, like earlier, has a compound annual growth rate of 150% over a 5 year period. I just think that it's not even like one of those things where you're saying, I don't want, like, I hate the government. I'm going to abolish it. We're going to change the financial system. All we're saying is, like, I just want to have the ability to use my labor today, earn dollars, and have those dollars be worth something in the future. Right. Like, that's all you know, the, I guess I'm struggling to wrap up the point there, but you get what I'm saying.
I do, and I'm drawing some stuff on the. I flipped over to the charts since we're going to transition to that anyway, and we'll. I think a good use of the last half hour will be to do some charting, some charts.
Agree.
So, are you able to see the chart that I'm looking at here? It should be the Nasdaq
I
100.
can.
I want to show you. I've drawn a couple of boxes here. This was 2009. So on the heels of the financial collapse, the Nasdaq moved from like 1900 down to like 1100. Okay, and then so next time, first I want to take a tangent. The next time somebody comes up to you or you hear somebody say, "Oh my God, we are on the verge of economic apocalypse. We're all gonna die." Okay, I want you to look back at the the worst days of the housing crisis or the financial the near collapse of our financial system back in 2009, and look at where, and we were what, at 1100 on the Nasdaq, and we peaked at 16.7, specifically 16,764. Okay, think about this move in terms of size. And if somebody had come to you and said, "Hey, it's not going to be no big deal, man, because in 2021 we're going to hit an all-time high of 16,764.86 on the Nasdaq. You'll be just fine." I can tell you that was not the sentiment back then. But I want to point out back to interest rates and why it mattered. Before we do that, harken back to the 2000 tech bubble and look at, in comparison, in terms of pure price action here, from 858 up to about 4,800. And then look at the last move from basically November 2020, like after the COVID puke, which wasn't even, in hindsight, wasn't even that big a deal. I mean, a lot of people, this is a monthly chart, by the way, a lot of people's pooped themselves during this period. I was one of them, watching from the sideline going, holy. Anyway, if you look at this move, I'm going to explain a couple of things real briefly here. This first purple box is the bottom of the housing crisis. What went to zero during that time? Not risk assets, almost housing, but interest rates were immediately dropped to zero. Okay, so that meant that the cost to borrow dollars in the U.S. went to nothing. So then, and I remember hearing Paul Tudor Jones and someone else back in basically 2016, talk about how for the last 8 years the trade, like the trade, was the Fed. The Fed put rates at zero and left them there for such a long time that it didn't matter what you bought, you just bought everything because it was going up. And if it's going up, you buy it, and you buy it because it's going up. That was the circular logic that zero interest rate policy, monetary policy in the US. And what made it even better for US risk assets is that the interest rates in Europe were negative. They went below zero. It was basically a tax. If you had money in the bank, it was a calculated, it was eating away at your principal. So anyway, the point I'm trying to illustrate here is that zero interest rate policy ripped markets back to the pre-2000. You see that they paused here in 2015 because everybody thought there's no way. There's no way. I remember watching CNN and CNBC and MSNBC and listening to them talk about, oh my gosh, we're back to the tech bubble highs. Little did they know. We interest rates stay the same, low or like zero or very low, and it just accelerates. And then we get we get this pullback here. This is this October, and like October, November, December of 2018. We get this correction. I remember people like claiming the end of the world. Interest rates are still very low, but they were about 3%. And I think when the 10-year Treasury hit 3.5% is when Jamie Dimon got on TV and was like, "Oh yeah, this is probably bad." And but we only corrected this much. It still was very painful for people that were watching the chart like this close with binoculars. It looked like the end of the world. We then find markets found a way to then break through that and get back up here. And then all of a sudden we get the COVID shutdown. And what happened? Interest rates right here in March 2020, what did they do? They went right back to zero. And that reignited the Fed trade, in my opinion. And anyone else who profited from this would likely agree that the catalyst was interest rates are now back at zero. Money is cheap again. Borrow as much as you possibly can and throw it into anything that moves. And we saw the NASDAQ rip from 76 all the way up to 16.7. So another eight, basically went from 8,000, it doubled. Okay. So the NASDAQ in less than a year, or less than 2 years. So in less than 24 months, we watched the NASDAQ double in value. Did companies double in value, or did the cost of capital get good again? So I'll pause
Yeah,
there and
something
say,
interesting.
yeah,
Yeah, something interesting there too, and just a thought of looking at this. But a lot of people that don't, that have basically shit on crypto over the past year, pull up a Bitcoin chart, and you'll probably see that over the past, since the thing that we can't say on YouTube happened in 2020, uh, the Bitcoin chart it responded pretty similarly to the Nasdaq, right? And so
yes,
this is what we're looking at with correlations and why we're talking about rates. And moving forward, I don't know what the effect of these higher interest rates will have as it coincides with Bitcoin happening and 4-year cycle. I mean, does Bitcoin eventually break free and say, hey, I don't care about interest rates, it doesn't matter to me, I'm going to go up anyway? Or does it continue to trade with the NASDAQ, right? And I don't know the answer to that. I just think it's interesting to point out the correlation between the NASDAQ and Bitcoin as it's existed over the past year, because it wasn't just the crypto markets that tanked, everything tanked. And so,
mm-hmm.
it's important to remember that and draw the correlation between the rates moving forward so you can kind of see, okay, well, if the crypto markets do start to react differently, it's important to notice, because that's when I think you'll really start seeing people that haven't really paid attention to the crypto markets really start to pay attention and go, hold on a second, what's going on here? What are your thoughts on that?
Yeah, the treatment that Bitcoin and then the rest of crypto uh, get, the treatment that they get from the global financial crowd is that, so in the global financial world, people look for something new. The only way to rationalize it that I've seen is that you find how similar it is to something else. And it's like, well, we're going to trade Bitcoin like a tech stock because it is a digital monetary network. It's run on the computers that are on the internet, on the computer. And it's
Which is silly, right? Because it's not a tech stock. It's not a company.
it's not
It's
a company.
completely different. It's a whole new asset, right? Like,
There's no shares. There's no ability to dilute the shares. But that doesn't matter because Wall Street has to give people what they want. And in many cases, they tell people what they want and then do that. And they think ahead. And because the largest number of people in the US, for example, that have retirement plans, 401ks, think about this for a second. During like after the housing crisis, the global financial crisis in 2008, 2009, and in 2010, when people started getting jobs, or in large, or the like employment recovered and people started putting money away as they earned it, the incentives around 401ks and retirement plans that were part of your employment, your compensation structure. And just think about this for a second. Even through, I'm going to go back to the NASDAQ chart. So like even the last 3 years, like all of these, you think about this with money being so cheap, it's easy to be speculative and gamble and borrow money and just long these things. But this whole time, with all like even when these big pullbacks for like months at a time, and these red candles where price retraced a pretty big, like 1,000 points that it retraced here, which sounds like a lot, but in the grand scheme, it's not really that big a deal because you got all these other moves that eclipse that. But my point simply is that every 2 weeks, on average, in the U.S., okay, I'm just talking about the U.S., you have like 30, 40 million workers that are all participating in their company's 401k or some sort of retirement savings plan. What's on automation or what's automated? Boom, they're hitting the bid in a manner of speaking. They're buying their funds get distributed to the manager, and the manager just buys whatever their allocation is at any price. And you got to remember, like the I think stocks and risk assets have a long way to go until until in the U.S., for example, something I think about a lot is like when the boomer generation, which is the largest generation, starts to retire, leave the workforce, and more importantly, start to cash in their retirement plans and become the largest net sellers of assets for income so that they can live. I think that's when things get really interesting in the next 8 to 10 years, or maybe even sooner than that. But the point I was trying to get to is that today, our the reason the employment numbers matter is that when employment is up and jobs are plentiful, people are contributing. Their 401k and pension plan administrators are buying assets at any price because people are putting on autopilot and they don't want to think about it. What do you think about that? Isn't that insane? Or not insane, but I mean, it's crazy to me. Like every 2 weeks, we're hitting the bid.
well, and it's important to consider because I guess when you consider that and you think about all this, it, I'm trying to just in my head think of they keep raising rates. They've got this national debt problem that's growing every second. I mean, we talked about this earlier. That's the big question, right? At what point will they be able to not service the debt while raising rates, right? And at what point does that impact you and I? Because that's who's going to pay for this, right? Whether they raise taxes or come steal our shit, which, look, they can do. There's nothing, I don't care if you think you're the biggest real estate tycoon, you've got the best attorneys in the world. If the US government decides they want your shit, they can get your shit. So, like, at what point does that all this, I guess the question is, how long can they raise rates without breaking some of this, right?
That's a hard one, and I'll tell you why I think it's a hard one. I don't remember what it was like for my parents when they were buying a house and paying anywhere between 11 and 17% for their mortgage, like the interest rate on their mortgage. Their house was $30,000 back in the late 60s, or like I think it was 1968. they got the house where I grew up. They paid $30,000, and I think the mortgage payment was like $350 a month. But the interest rate on that loan, that a first mortgage, was probably 17%. It was either somewhere in the neighborhood of 10 to 12 or 17. I don't remember. I could find out. But I think about that when I like two houses ago for me. Well, my first house, I was at 7%, first time buyer. I put, FHA, what, 3.5% down. I mean, that was a drop in the bucket compared to what the house appraised for, and how much I was borrowing. So it was a great deal. But I thought that 7% was a lot back then. I was able to refinance it into four and three quarters, and it made such a huge difference. Then one house ago, I was at 2.99, which was fantastic. But put that in perspective, though. Imagine, we pay what, anywhere between 16 and 30% on our credit cards, depending on your profile. That used to be the rate that you would pay for a mortgage. But you think about now, with the way housing prices are, you buy a $600,000 house, and you would it would be out of the question to pay 18% interest, unless there was
Yeah,
no other option. You know what I mean?
people couldn't do it. Either if they keep raising rates, real estate prices are going to have to come down, or the whole thing's just going to go. And maybe, the thing that frustrates me so much is maybe that's what they want, right? Like that's the hard part because you're going, what is the ultimate goal here? And then we get back to, the whole reason to go into Bitcoin and crypto at all is because once you learn how the system is designed, even if all that happens and they raise rates until the real estate market breaks, a lot of people lose their home. That doesn't mean the system's broken. The system worked exactly as designed. It's just redistributed wealth from the normal person up to the guys in control. And that's what's so frustrating because that's what seems to happen every time, along with the fact that when the money starts to get a little wonky, we go to war with somebody. And that's the thing
Yeah.
that's really frustrating too. And we're in that situation too. So you've got that going on now. They're raising rates, and that's above my pay grade to decide, to tell anyone, hey, they should or shouldn't be. I don't know. But as an individual investor and trader, it's stuff that I look at and think, what impact is this going to have over the next couple of years? And, I just think it's something important to consider and think about when we look at different kinds of investments.
I'm going to transition us. Well, first of all, thank you for that. I'm
Yeah,
going to
well, he
transition
wasn't really
us.
going anywhere. I didn't really have a point. I just kind of blurted
That's
it
that's
out. But yeah,
that's all right. I'm going to transition over to the Ethereum USDT chart and the
okay.
tweet from Horn Hairs, which we should be able to see on the screen. I think we're good. So we'll talk about Ethereum. Really, I'll whiz bang through a few charts and talk about like the price action over the last few days, really around two things. Fed raises 25 points, 25 basis points. It's not as much as some people thought. It's less tightening, which is somehow easing. If you're, depending on who you're talking to, it's yeah. I don't. This whole quantitative easing, quantitative tightening is just it's maddening, in my opinion. But what we're looking at here is looks like the spot yeah, Ether US, like Ethereum USDT, the perpetual on this trading view chart from Horn Hairs, and I think the thing that what instantly when I look at this chart, I see the resistance areas that I've marked up somewhat similarly, not because I'm special, but because I finally, over the last couple of years, have been able to get over like looking at the chart and seeing where I wanted it to go and just like, seeing what was happening. And he points out here that this 1680 zone, or this level of 1680 at the time this was published, which was just like 2 hours ago maybe, uh, has been banging up against this resistance level. So we got one, two, three, four times that we've tried to go higher here. And I'll go over to the TradingView chart that we've been working on for a week or two now and marking up. And interesting to see the higher lows developing and forming this wedge, which it implies if your bias is long or you're bullish on this particular sector, then you're looking at this going, man, this thing, it doesn't want to go higher yet, but at the same time, it's not going lower. on the as it as money moves in and out of this thing, the price keeps the lower end of the range keeps getting higher and higher. So this suggests that if there is a retest of this resistance level, it might give out. That's what I take from what I read here. Are you able to see that chart as well?
I can see the chart now.
Okay,
Can you scroll over what resistance level you're referring to?
sure. I'm on the
There we
trading
go.
views side. I'm gonna flip over to that now here in the stream. So we drew this Fibonacci retracement piece back, I don't know, like a week ago, and we've watched it oscillate inside this wedge. And two things to point out here: when Powell gets on T or FOMC meeting adjourns and they announce that they raised only 25 basis points, we saw a bit of momentum to the upside. I would argue that's probably just trying to be realistic and not be sound like I'm like too emotional about this, but I took that to be a lot of people covering short positions to get out and get out of the way
Sure.
in case the wet blanket came off during that event, which makes good. I mean, that's just people protecting their investment and protecting their capital. And you see, we got up and poked through the top of this range that this line, this resistance line. This is that right here is that look at this, the 786 just above the 618 is the 1680 price level that's proven to be resistance one, two, three, four times now. Now it's pulled back a little bit, but it only pulled back to retest this little consolidation zone here at the 618 on the previous Fibo diagram. We put this box over here to suggest that if conditions remained more accommodative, meaning Fed was going to be less hawkish, and access to credit and capital was going to be not quite as expensive if they continue to hike at the 50 basis points level, that we would consider initiating a long position with the idea, or the idea is that we would blast through this 1680 to 700 zone, and then people that were their bias was short would cover, get out, flip. And this resistance layer at 1680 that's been resisting, it would become support. So back to the tweet for just a second. It says, "I will be surprised." The Hornhair says, "I'll be surprised." I'll be surprised if this holds for a fifth time. Okay, great. That's an interesting thing that dovetails with what we've been talking about, is that this top line resistance layer, once it gets flipped, then I think we have a lot of room to move, because that what it implies, in my opinion, is that this former resistance level back in October of last year, October, November, before FTX came along and banged a lot of people, is that we plow through this 1680, 1700 zone, and then the next leg up is to basically 1800, which it is likely to consolidate around that area. And if the momentum is good and the macro is not of the headwind nature, if there's macro tailwinds, if we get a bunch of, and ironically enough, we get a bunch of bad economic news about bad sentiment or bad this or bad that, that implies that Fed policy is too tight and it's making everybody's lives miserable, they may get on TV and say something dovish, and then that puts us back into retest this 2000 number here. So that's what interesting to see the tweet from the old horn hairs here, that kind of dovetails with what we're seeing, is that this is a pretty established resistance layer. We're looking for it to either plow through and become support, or if there's just not enough, if the market's not ready, and then it's going to retrace, it'll retrace back down, and I don't know where it would land, but we would probably be looking, if I was if I was looking to grab this at a discount, it'd be like in the 1300s, like 13 to 1400 range here. It might land, given the way it's run up. Anyway, I think the more likely scenario is crypto PTSD, which you talk about a lot, or like this bear market PTSD. A lot of money still on the sidelines. I think it goes higher, in my opinion. What do you?
Well,
What say you?
yeah, so the kind of way I look at this is like I consider a lot like how I feel about the markets, and then I try to do the opposite because, and it's not because I think I don't understand it or I'm stupid or I can't do it. I just absorb the same information that everybody else gets. And I understand that, like, what the market, like, how I feel right now is irrelevant to what the market's going to do. Everybody and their brother thinks the market's going to go lower, right? Well, a lot of times the market doesn't do what everybody wants it to do, right? Shocking, you know? So if everybody thinks it's going to go lower because of stuff you say, as long as we don't get any sort of macro headwinds or something that crazy comes out of left field with crypto, I think there's room to go higher, mainly because everybody thinks it's going to go lower, right? And that's not a great reason to take a trade. But if you were to ask me what my opinion is based off kind of what you've charted out and general sentiment, I would tend to agree there's a chance that it could do that. But again, we talk about when taking trades and when kind of looking at this stuff. Ultimately, it doesn't matter if we're right or wrong because what we'll do is we'll set aside stop loss. We'll only risk 2% of our portfolio, and we'll enter the trade based off the best ability we can to make a prediction and see where it goes, right? And then if we're wrong, we'll reassess. If we're right, we win a trade. On to the next one. But that's kind of my 2 second spiel on what I think is going to happen. And I don't know, right? Like, so this is something just so everybody knows I'm learning this. Ted has a lot more experience with charts. My experience is kind of in the venture side and investing. So you might hear Ted ask me stuff, and hopefully, what I can do is ask some of the questions that everybody else is thinking because I don't know, right? And but if you're going to ask me, that's what I would say it is going to happen.
Well, I've asked you on purpose because I want to know, or it's important for people to hear other people's perception and perspective because when I look at the chart, it's I can't I'm not an AI uh, I'm not an AI avatar that can look at 6,000 different data sets in at the same time and pull all that together. That's not how my brain works. What I'm seeing is that throughout all of this like downward all of these this terrible things that happened, the FTX thing was the biggest one recently. It only went down this far is what I'm trying to say is that this market is being supported and it's consolidated. This looks like healthy consolidation that implies, hey, remember taking everything that you hear in the media and what people are saying on national television and in like mainstream media. The thing that matters is where the price is, quite frankly, at the end of the day, because if you're just trading the news, then fine. But the chart literally tells you where people are, like the people that are putting their money where their mouth is. It shows up on the chart, and I'm looking at this to say if I were to flip this chart upside down, I could probably do this in TradingView, but I don't know how to do it. I won't waste the time that we have like 6 minutes left on the clock here before we need to
Well, and by the way, I got to hop
finish
out
up.
early, but if you want to stick around and do some charting, totally fine.
Maybe I'll do that. I don't know. Anyway, what I'm seeing here is that this is setting up that if if we get a strong, like any sort of strong movement over this, it's going to get people that were building short positions over the last 3 or 4 months. If you're short right now, like if you sold the FTX event and you didn't take your profit, or if you're looking to like basically like if you're supporting the market going the other way and you're adding to your short here because you're not stopped yet, then if we get a definitive and strong move up, that's going to get a lot of people. Or let me say this, I'll say this another way. The big boss used to say, what we really need right now is a bunch of people to get in short.
Well,
And
it's fuel for the fire, right?
that's right. So that like people getting forcibly liquidated and people panic buying to get out of their short positions because they'll get wiped out and they want to live to see another day. Once you get the right move up triggers this, and then as people that were biased long start to take some profit or trim their positions to so they can get paid and eat and all that good stuff, Then you'll see the market come back and retest this and say, is it now support? Yes or no. If it holds, then then you get another defining move up. I mean, that's what I'm seeing right here.
And
And then
those are the trades that I like when they break through, come back, test, and then you can tell that it's coming back up. I think that makes a lot of sense to try to enter those kind of trades because you have confirmation of the retest, right? And so that's something that I've looked for in the past, and that's something that just makes intuitive sense to me. Uh, I just
well,
wanted to throw that out there. Yeah.
last thing I wanted to say though is that like I happen to think that it goes higher, but it wouldn't be fair, and I'll do this in like 30 seconds. If the sentiment and other factors, there's a confluence of things that basically dictate that price is going lower, it would stand to reason that if you're not ready to risk, if you're not ready to be risk on and long the hell out of this, then you would wait for it to come back down and settle and collect in this lower part of the wedge here. That would imply that it needs to test this level to see if the market has determined that it really isn't worth 1700. If it's only worth 1,000, then the market will move that way. And if it were to break down to these other levels, then I mean, it may have to do that. I don't think that's the case, but I would imagine like this, if it does pull back, it'll pull back into this level here, into this zone for some amount of time, and then people will reevaluate like the risk reward. I would argue that the risk reward's probably a little bit better. Oh wait, we lost Josh. Darn. All right. Well, let's go ahead and wrap it up. Looks like Josh dropped off. But anyway, thanks for watching. We will be back at this tomorrow. And just remember, do your own research. If you do trade, make sure you understand the counterparty risks that you're taking and you're employing proper risk management, and you consult a financial professional if you need to. So thank you, and we'll see you in the next one.